Most of us interact with artificial intelligence every day, whether we know it or not. Algorithms that show us the best route to take or make suggestions when we use search engines all use some form of AI. But generative AI, like ChatGPT, is a whole other level.
Most of the AI that we've been using to date have been what we call classifier models, or classifier trained on images of animals could identify an image of a dog with a probability that that's a dog. But generative AI is different, where it's trained on, let's say a model trained on images of animals. You can ask it to generate an image of a dog, and it will do that. But that dog will be entirely unique. It's not going to be a copy of another image. It's going to be a new dog image.
Technology like ChatGPT has given everyone a chance to experiment with generative AI in their daily lives, from improving their productivity to planning a vacation and even investing. Its ability to have meaningful conversations, write an article on any topic, and manipulate images has sparked awe and caused concern. Proponents feel that they are standing on the cusp of the next big thing in technology.
Generative AI is here to stay. They will be impacting positively to every other potential industry that you can ever think of.
Semiconductor firms and makers of electronic design automation, network infrastructure, and software are heavy users of artificial intelligence and machine learning.
Really at the base of all of this excitement are advanced semiconductors doing the data model building and then the inferencing on that data. The next set of players are the companies that do something called electronic design automation. Essentially, these are software companies that help firms like Intel and NVIDIA, but also some of the big tech players design their own special chips that can be used for building these models and doing some of the inferencing functions. The semiconductor capital equipment companies that sell equipment to the foundries, like a Samsung or a TSMC, to help them build these advanced semiconductors. The next set of companies that are going to really do well are the cloud providers. And then those very special companies, you'll find them across industries, that control some unique and compounding data set, typically with a critical engagement layer attached to them, combined with the engineering and AI talent to innovate and weave their insights and their algorithms into their core products and processes.
If you'd like to hop on this technology theme, what is the best way to do it?
At the top of our portfolio, in our top 5, we own names like NVIDIA, incredibly well positioned for this opportunity. They not only build the special GPUs, but then they build software around those GPUs to help software developers build their software more for a parallel processing capabilities and to accelerate the machine learning model building. And then also they've started introducing chips for inferencing. Microsoft, I think, has an enormous opportunity. Now, there's a lot of excitement around what they're doing with Bing. Maybe I'm a little less excited about the opportunity in search, but I really like what they're doing to make knowledge workers more productive.
The other way will be to what we call a more purer play AIs, and that is to identify companies that derive a larger revenue as a percentage of their total revenue from AI. Of course, certainly another way will be to look into funds, and by funds we can also look into 2 types. Number one, the active funds will be some of the managed funds, or what we call unit trusts or mutual funds. They are invested with the underlying of AI-related companies. The other one will be a more passive way to do so, and that will be through ETF, which is the exchange-traded funds.
But some investors may be wary of venturing into tech stocks after the drubbing they received last year due to rising inflation. But experts say 2023 will be different.
We're starting to see signs that inflation's getting under control. We think that central banks, especially in response to some of the pressures that we're seeing in the financial system, are going to have to slow or maybe even reverse some of their interest rate increases. So that's positive for multiples on duration assets like high quality tech businesses. And then secondly, and perhaps more importantly, is the technology sector, unlike many other sectors of the economy, has already gone through its recession. It's been cutting estimates. It has been getting much more efficient. And I think that it's going to look, at least in relative terms, pretty strong versus other sectors.
The big risk for investors is that the technology is so new that regulators and governments are still deciding how to deal with it. Italy became the first Western country to block ChatGPT, while others have indicated that they might follow suit.
Generative AI is one of the technologies that's used predominantly for generating fakes, particularly in the area of images. And then these models can be misused as well. So there's all kinds of opportunities for malicious use of these models to create malware, to create phishing emails, and those kinds of things as well. And there, is just a significant risk right now around copyright. So these models are created using internet data scraped from the internet currently, without necessarily having all of the copyright permissions that they needed to use that data. And so there's a number of lawsuits out right now that are still pending, that are dealing with copyright issues in the creation of these models. So there are significant risks for organizations moving forward.
There are also lessons from investors who got burned in previous tech bubbles, such as the dot-com bust and the recent crypto collapse.
Look at the breadth of its involvement, its benefits that it can bring to the other sectors. Is it broad-based? To me, I think it is broad-based. What kind of price are you paying for a particular company or even for an index based on the ETF?
Look for high-quality businesses, companies that have moats, companies that have good unit economics. We're okay if these companies are investing, but they need to be investing efficiently. They need to be certainly well capitalized in this time. They need to be in a large market that can deliver sustainable, predictable growth, and then make certain you're paying a good price for what you're buying. So do your valuation work is my point. So own high quality things in large and expanding markets and that are trading at discounts to intrinsic value.